Prices climbed more than expected in December, according to the latest inflation data from Statistics Canada. The overall headline rate on an annualized basis increased from 3.1% in November to 3.4%. It was driven by higher gasoline prices compared to the same time last year, along with airfares, vehicle sales, food prices, and rent. Strip out the most volatile items, as the Bank of Canada does, to drill down to the core inflation rates, and it looks worse. Core inflation also accelerated to as high as 3.7%. Remember, the Bank of Canada's goal is 2%. So it likely means interest rate cuts won't be coming down just yet. But let's get an economist take on all of this and bring in Benjamin Tal, Deputy Chief Economist at CIBC. Benjamin, thanks so much for joining us this afternoon.
A pleasure. Thank you.
So we talked last time about the buffet of inflation data out there for the central banks to pick away at. They've got options. But when you look across the data that was out today, it all looks a little bit worse. How would you interpret it?
Yes, a bit worse, but again, you can find some good numbers, you can find some bad numbers. If you look at CPI-X, which is core inflation minus the 8 most volatile items, it actually went up by 0.1% on a month-on-a-month basis, as opposed to 0.4 for all items. So depends where you look, and you can find all kinds of good numbers. But yes, it was a bit disappointing. The 3.4 was not a surprise because of a base effect. 13 months ago, gasoline prices went down, so it's out of the calculations. Therefore, you saw this jump. We have seen some increase in CPI trim, what the Bank of Canada is looking at, and CPI medium. But at the same time, if you remove mortgage interest payments or shelter, all of a sudden the numbers are not so crazy. So really depends where you look.
So, okay, so some of those pieces, when you're talking about the base effects and whatnot, does that mean that next month, or technically this month, when we get this month's data, that we could see inflation easing back a little bit? What do you think we should be watching out for?
Yes, absolutely. So you look at the inflation, it's not linear. It will go like that, like a yo-yo. 1 month will be fine, 1 month will be less fine, because depends what happened last month or last year. And therefore, we look at month over month, 3 months moving average, 6 months. You try to get a sense of what's really happening today, not a year ago. And that's something that everybody's looking at. And all of a sudden, you have like 30 inflation rates to look at. And that's why it's so confusing, which means that at the end of the day, the sentiment of the Bank of Canada is really important. The language, the body language, the market will start looking at what they are saying and listening to what they're saying even more, because you can find the number that you want. So the narrative will determine the data and not vice versa. That's extremely important to understand. Yes, the numbers today were not great, but the trajectory is downward. The economy is basically in recessionary territory. I think that the Bank of Canada will be very careful with interest rates. I think that they are done. That's almost a given in terms of raising interest rates. I think the market was a bit optimistic about when the Bank of Canada will be cutting. They were talking about April. I think it will be more June, July. The Bank of Canada has to make sure that this inflation is absolutely dead before they cut interest rates, even if it means keeping it up for 2 or 3 months extra.
Yeah, it is interesting on the body language front there, Benny, as well, because we're going to actually hear from the governor of the Bank of Canada more often. We're going to get those press conferences every time that they make a decision. So there's more opportunity for Canadians to be tuning in to see, a little bit more color on each of these decisions that it does make. When you're taking a look at the Canadian economy, I mean, you mentioned that it's sort of near recessionary levels. Is that how you'd characterize the Canadian economy right now?
Absolutely. It's either a very, very, very soft landing or a mild recession, one of the two. But we are talking about very close to zero. We are definitely in a per capita recession. That goes without saying. We know that. So the fact that the economy is operating at only 0% GDP growth, with so many people entering the economy, suggests that this is not a healthy way to grow an economy.
A very, very soft landing does sound a little sweeter than a recession there. Benny. So how, when you're looking at the Canadian economy in comparison to how the U.S. economy is performing through this, give us that sort of context or contrast.
Yes, that's a very good question. So you look at Canada, basically zero. You look at the U.S., 4.5, 5% like China. like an emerging market. What's going on here? So, of course, there are all kinds of excuses. Fiscal policy in the US is much more significant than Canada. So that's one aspect. We are much more sensitive to higher interest rates relative to the US. That's another aspect. Productivity in the US is rising. In Canada, it's basically falling, another factor. But I think at the end of the day, although the US is doing better, the gap is not as crazy as perceived. Why? Because I'm not buying the fact that the US economy now is expanding at 5% annual rate. Why? Because there is another measure. We always talk about GDP, gross domestic product, but there is something called GDI, gross domestic income. Supposed to be the same, but this gross domestic income is actually rising by maybe 1% in a good day. So there is a significant gap between those two measures that's supposed to be the same. One of them is expenditures, one of them is income, supposed to be basically the same, because when I buy something from you, it's my expenditure and your income. So it's supposed to be the same, but of course, they measure it differently, different sources. The gap is huge. We're talking about 1% versus 5%. And the research that was done by the Fed itself suggests that when the economy goes down, guess who is better predictor? GDI. And that's why I believe that the truth is somewhere in between. The US economy is not as good as perceived.
What is behind the gap, do you think? We were just looking at your chart there, Benjamin. What do you think is causing that gap?
It's measurement. Theoretically speaking, it's supposed to be exactly the same, but they use totally different measures. And some of them based on surveys. GDP is based on a lot of surveys. GDI is based on real data. Some of it is real data, like unemployment insurance and so far. So I think that when it comes to a changing direction, the GTI is more precise. And therefore, I think that the US economy is not as strong as perceived, but it's basically data measurement. Eventually, they will touch base, but it takes time, especially when the economy changes direction.